we have joining us William Lee, who is the Chief Economist, Managing Director, Global Economics Advisors. William, hi. Good morning, Sajid here. How do you look at the current macroeconomic situation? Do you think it's still work in progress as far as the US-Iran talks are concerned?
Well, we have definitely seen not only this movie before, we've seen the sequels of this movie so many times now. The markets, I think, have been reacting very calmly. The price of oil, as much as it has fluctuated, has been range-bound. It has not gone much below 80, and it's not gone much above 100. And I think that range-bound condition represents the uncertainty the market has over who exactly is bargaining for Iran right now. And then how credible are any of the promises that are made at the bargaining table? And I think that has to be resolved because we already saw how an MOU disappeared even before the ink was dry. So I think the hardships that Asia is suffering from, the fact that Asia is so dependent upon the Strait of Hormuz for getting its energy supplies is something that is unfortunate. But the global markets have moved on. Has taken the geopolitical risk and put it aside right now because it has put a pricing range around oil. But it's really focused now on the AI trade and where that's going. The profits reports that have been coming out this quarter have really been exceedingly good. There's evidence that companies like Palantir are leading the way in terms of applications of AI in places where you can actually see profitability. And I think that is a foreshadowing of where the AI trade is probably going. And India, I think, has yet to benefit from a lot of this because a lot of the capital that would have flowed into India has gone into the United States because the global investors are still not convinced that they need to diversify out of the United States in order to benefit from where global markets will be going in the future.
But William, having said that, does it seem like those extremely elevated levels of beyond $90, $95 to a barrel on oil, are they behind us? Because India is extremely sensitive to the way oil moves.
Yes, absolutely. And India, I think, would benefit greatly by diversifying away from the straits. The deal that India made, for example, the United States in trying to use the small modular reactors to fill in gaps and places in the grid where you can have the supplemental power is I think a lesson to be learned. But I think the days of 90 and above are still ahead of us. I am not convinced that the bargaining table will get much in the way of real peace and opening of the Strait of Hormuz until we actually see some real concession on the part of the Iranian government. And right now, it's not even clear where the Iranian government is. Is it sitting with the Iranian Guard, or is it among the more moderate factions that are at the bargaining table? And President Trump, I think, has demonstrated that he is at his at the end of his patience. He was much ready to just put an end to all of the military capabilities of Iran. And I think he has demonstrated that he has been pulled back a number of times because he was somehow convinced, and he seems to have a bias toward peaceful solutions as opposed to just all out, one final battle to end all things.
William, hi, morning. This is Harsha. You clearly don't seem convinced that this problem is going to go away in a jiffy. Is this going to be a multi-year kind of a problem, and will markets now start to overlook the problem at all? Is that something you're starting to pencil in at some point of time?
I think the geopolitical risk, as you said, is now contained. It's been priced by the markets, and you see the ranges. Not much above 90 to 100, and not much below 80. And I think until alternative energy sources are really put in place, we're not going to be able to crack that range very much. Meanwhile, I think for example, the rationing that goes on in a lot of the Asian countries, India in particular, will be unfortunate for a lot of the households, which I think puts a lot of political pressure on the government to find ways of diversifying your energy sources. Now, unfortunately, that takes time, and right now there isn't a lot of time. So patchwork solutions like importing liquefied natural gas from the United States and other sources is about the only other alternative that Asia has. Oh, by the way, one alternative that people just don't talk about is the fact that China has got an enormous amount of reserves in its strategic reserves holdings. It's got holdings that are about twice the levels that are recommended by the International Energy Commission. I don't see China helping its Asian partners by selling and pumping out stuff out from its petroleum reserves in order to export to other Asian allies. That I find very strange for a country that is trying to be a good neighbor and in trying to establish a network of trading partners and to be a reliable trading partners for its Asian neighbors. So I think that's one thing that I haven't heard much press about, and I think more political pressure can be brought to bear on China on the part of the ASEAN and Asian countries in general to try to increase the supply of oil that way.
Okay, William, last off, how should one allocate across asset classes? Should one diversify outside the US if one is invested at this point of time? How should investors respond? Should gold be the go-to at this point of time? Also, given the kind of fall we've seen, how should you play it?
That's a great question, and I would suspect a question that someone that was educated in most business schools would say. You learn. I think one of the first lessons you learn in business school is there's no such thing as a free lunch except diversification, because that's where you get a free lunch. Let me bring you to the words of Warren Buffett, who says, diversification is nothing more than diversification. You're worsening your portfolio performance because you're spreading your investments across ideas that you are not convinced are your best ideas, but you just don't know, and therefore you try to worsen your portfolio performance just to be able to guard yourself. I'm not a big believer in diversification for your entire portfolio. And so for the base portfolio that you already have diversified, the marginal increments to investment portfolios, the marginal allocations should go to the places where capital is used most efficiently and most effectively. And unfortunately, for a lot of the emerging markets, that place is still the United States. And I don't believe global allocators are going to be spending much time diversifying when they can clearly catch the tailwinds of this phenomenal investment opportunity called AI trade.
Thanks, William, for joining us and giving that perspective.